Welcome back to Wake Up with Cheddar, everyone, live from the floor of the New York Stock Exchange. I'm Brad Smith. We've been tracking futures this morning. They are flat this morning now as investors await the Friday jobs report just a couple days away. And we're continuing to monitor inflation. Take a look at the stock futures. The S&P 500 futures have slipped into negative territory, flat but to the downside right now, but just by a point. We'll see if it gets back into positive territory prior to the market open. And the Dow Jones Industrial Average, you are seeing those futures flat, but to the upside, to the tune of about 0.1%. We'll round that off to 29 points there. So the Dow and the S&P 500, we'll continue to watch those. The NASDAQ in the red. Inflation remains at the top of minds for many investors as expanded manufacturing data. It's stoking some fears that the Fed could potentially lessen its monthly asset purchases. This is of course, coming ahead of a strong U.S. jobs report that could also raise concerns that the central bank may pull back support. Meme stocks, we got to talk about this. They are also in focus today with AMC and BlackBerry surging to near record highs. We've got more on that in just a moment. But first, let me bring in our next guest. I want to bring in Thomas Hayes, who's the chairman of Great Hill Capital. Thomas, let's rush to the finish line here because, I mean, ultimately, I think if we have some time on the back end, we could talk about Baby Shark, i.e. Elon Musk, and a la Elon Musk, I should say there. But anyway, markets mostly flat this morning after the muted start to the month of June. What do you believe is behind this?
Well, I think that basically the market is absorbing what's been a huge move off the pandemic lows. We're up close to 90% here, and it's getting a lot harder to find value in this market, Brad. One of the great groups that we're focused on these days is Chinese stocks. They've gotten hit tremendously hard from February through May, and they were hit for basically three key reasons. First off, you had the Archegos Bill Huang blow up. They had to unwind about $100 billion of Chinese stocks. Secondly, you had the Chinese government cracking down on the group. They did the $2.8 billion fine for Alibaba. They delayed the Ant Financial IPO. They're cracking down on the live streamers, which is the online equivalent of QVC with social media influencers. And they've cracked down on the online education providers. This has been going on for years, but it's ticked up in the past couple of months. And then to your point, Brad, the third reason that tech and Chinese stocks have been down are those inflation fears. And that really started, you saw in February, the 10-year yield went from 100 basis points to 175 basis points in about 6 weeks. And when you have that type of rise in rates, that discount rate increases, those long duration earnings, which tech companies are known for, looking out 3, 4, 5 years, become much less valuable when rates go up that quickly. Now that rates have stabilized and we're seeing a number of the commodity basket, like lumber, like grains, pretty much everything except for oil coming in, some of those inflation fears are subdued. And that's why we're looking at some pockets of tech, and particularly Chinese tech, for value in a market where everything's gone up tremendously.
Okay, so what are we thinking right now? I mean, I'm looking through a couple names, particularly that are down year to date. Tencent Music Entertainment, one of them. Alibaba, as we were mentioning just a moment ago. I just had that up on my screen, and that seems to be down year to date still at this point in time, and really not too high off of some of the most recent lows that they set in May. And so with that in mind, is that where you're looking towards right now?
You bet, Brad. Our top pick in the group is Alibaba right now. This is a new pick for us. And if you look back since its IPO, the average PE ratio, price to earnings multiple, has been about 28 times. If you look at next year's earnings, it's now trading at about 18 times 2022 estimates. So all of this bad, kind of bad news from the government crackdowns is priced in. And I think a lot of it is behind us. Now, here's the other interesting fact. You can buy Alibaba today for the same price in June 2021 as it was in June of 2018. What's the difference? The difference is they've doubled revenues, they've doubled cash flow, and they've doubled earnings, and yet it's at the same price. So we think this is a tremendous opportunity. The other reason is obviously the Ant Financial IPO was delayed for political reasons. We think that's going to get done. It's about a $300 billion valuation. Alibaba owns about $100 billion of that. That will be very promising. Their Amazon Web Services equivalent, their cloud equivalent, is growing so quickly. Within the next 3 to 5 years, it could be larger than Amazon's Web Services. And then finally, what we saw in the recent filings, Charlie Munger in Q1 made a huge purchase of Alibaba. Daily Journal is his investment holding company. Effectively, it's now 20%. 20% of the portfolio he bought is now Alibaba. So these are some of the reasons that we like Alibaba. We like these kind of out of favor groups. And if you look at seasonality over the last 20 years, on average, the tech sector as a whole, the first 6 months of the year tends to be subdued, sideways to flat, and then it starts to pick up in the summer to the back half of the year to finish out the year strong. So we think we may get some seasonal tailwinds that help sentiment change and has money start to move into these, with commodities now stabilizing, with rates seem to be stabilizing. It could be a good contrarian place to put some money to work.
You know, as you brought up the IPO market just a hot second ago with Ant Financial, more broadly, what are you tracking for as we go on throughout the rest of 2021? We had Stacey Cunningham, the president of the New York Stock Exchange, here on our air with John Steinberg last week, talking about the SPAC market and some of the changes that had taken place there. Of course, that was a red hot SPAC market last year. You also saw a handful of big direct listings that came through and some companies that went the traditional IPO route. And so with all of these options in place, what do you expect to be the scenario as we move towards the back half of 2021?
Yeah, well, certainly the SPAC market heated up very quickly and cooled off very quickly. One of the areas that we're actually looking at, which you have to be careful and experienced in, is with so many of these SPACs that have actually announced deals. And, the SPAC price is usually $10 per share, and then they announce a deal. Some of these deals, after they were announced, the stock went up to $20, up to $30, even up to $60, and they've rolled back over, in some cases below their IPO price, to the low teens. And what we're picking at is the long-dated SPAC warrants. So they're usually 5 years out to 25, 26, 27 at $11.50. And in those cases where you had the deal announced, so you don't have to worry about a deal not getting approved or not getting through, that's a risk if you own the warrants, we like this long-dated premium if it's a good company with growth, if it's a good sponsor with a proven track record of success. That just simply got out of favor because the mania that drove it up also drove it down. And as you look 4 or 5 years out to get that long dated exposure for a couple of bucks, these can be tremendous, particularly if you buy a basket of 5 or 10 of these things. 2 or 3 won't work, but the other 6 or 7 could be up 3x, could be up 5x, could be up 10x plus with a good company. And we see great opportunity there. So while other people are saying the SPAC market is done, we're seeing a tremendous amount of opportunity amongst the rubble to be carefully selective and to size and risk manage, because not all of them are going to work, but the ones that do could be huge multiple outcomes.
All right, so much to get to, so little time. Thomas, just very briefly here, inflation and those concerns that we're tracking going into this Friday jobs report as well, where we're also going to be watching where wages come in at and where the re-entry into the services parts of the economy also see jobs tick back up. What are you expecting both on Friday, and how do you expect the Fed to read into that report?
Yeah, well, I think what we saw with last month's was such a huge miss, 260 some odd thousand, 66,000 versus 700 plus thousand expected. And this is odd considering how few non-farm payroll job ads there were, considering the amount of JOLTS, the job openings available, hitting a record high in the entire series of data. So what happened? There are a number of theses. Number one, more women are staying home is the expectation because they have to school their children and take care of different things. So that might be helpful. And then many of the states started to say, well, it's not that. It's the fact that they have the extended unemployments through September. People don't want to go back to work because some of them make more money staying at home. It's unclear whether that's true or not, but 24 of the 50 states actually extinguished those extended unemployment benefits. 26 of the states have still kept them. So I think between now and September, we could see a decent jobs report on Friday, but I think it's going to be subdued until September when all of those benefits roll off. Now, that's the bad news. The good news is this is going to give Chair Powell and the Fed cover to delay their talking about tapering. So going into this, the consensus was that you would see tapering, the paring back of bond purchases, the $120 billion a month. You would see that in Q4 of 2021. I think with these subdued reports over the next few months, you may see that delayed out to Q1 of 2022, and the market's going to like that, particularly if you don't see anything coming out of the Fed in August. That's when people are anticipating they'll lay out their taper plan. If they punt on that due to kind of subdued jobs reports over the summer, then you get an extra quarter, and the market will be very happy to finish the year in that type of environment with no tapering.
All right, Thomas, we didn't even have time to talk about Elon Musk's baby shark tweet. Perhaps that for another time, though. Thomas Hayes, who's the chairman of Great Hill Capital, always a pleasure to speak with you and catch up. All right, guys, when we come